Good day, fellow investors. Discussing the key factors you need to know when it comes to the Fed and its actions. Wherever you look at what's going on, you see that the Fed is always there. Everyone is focused on the Fed. It's even more important than nuclear threats in Europe, because this was on Wednesday. So, okay, war, yes, but then as soon as the Fed hiked rates, boom, more pain to come. And top of the news, of course, dot plot signals policy rate stopping, and the market reactions is incredible. First it was down, then on Powell's comments it was up hugely from the bottom, and then we went even lower at the end of the day, Wednesday. I'm filming this Thursday morning. So the discussion topics for today are what the Fed can do and can't do. If you understand that, then you have an advantage when it comes to investing. I also want to go through Ray Dalio's recent letter on LinkedIn. Subscribe to Ray Dalio, and incredible letter. It all starts with inflation. Then we have the next topic, short and long term impact on investing, the predictability of all what the Fed does, and how to invest so that whatever the Fed farts, you'll do well. And this quote is really explaining what's going on in the environment. As Hemingway says, how do you go bankrupt? First gradually, then suddenly. That's what we are living in. And now I really don't trust the Fed. They say don't fight the Fed. That might be okay short term, but also don't trust it. Let me explain my views here. I found this very interesting, let's say, picture. So a year and a half ago, quantitative easing won't cause inflation. Yeah, some inflation, but transitory. Okay, inflation, but we are peaking. Okay, inflation maybe not transitory, but job market, wage, everything very strong. We need now to hike aggressively to curb inflation. Just go back, won't cause inflation. But no worries, economy very strong and soft landing very possible. Then we are now negative growth in Q1, but no recession risks. And now with the recent meeting and everything, Powell signals a recession may be price to pay for crushing inflation. So whatever the Fed farts usually changes a few months later. The situation now is, this is from Bloomberg, the daily letter that they say, great overview of what's going on. The Fed is lifting rates above 4% this year. So GDP estimations marked down, so likely recession. The bottom line, we are heading into a recession because the Fed implicitly acknowledged that with its projections, the US has never avoided a recession to curb inflation that high. Exactly what Druckenmiller was saying a few months ago, because he was better than the Fed. They will tighten until sufficiently restrictive, and then of course stock went to a wild ride. Just to finish on this, okay, recession coming, but you will not lose your home. That's what Powell is saying now, exactly. Okay, you may lose your home, but you won't starve to death. Okay, you might die, but you go to heaven. The Fed is insane. Now, I will give you a lot of factors information here. If you like that, please hike that like button to support the channel. Let's dig into the content. The first thing to understand is the Fed action and the impact on the market. We have seen it has been crazy on Wednesday when they announced the hike. First the market tanked, then when Powell was speaking, the speculators pushed it higher, but then the fundamentals were clear and it tanked again. So the Fed action and the market impact is key, and the key is that when rates are up, asset prices goes down, as Warren says.
Everything is off of interest rates.
Thanks, Warren. And the thing is that in the short term, the news, the rates are news. The medium term, all it matters is expectations, and then in the long term, what matters is fundamentals. And this is perhaps the key chart to understand. Over the last 40 years, we have had a 40-year bull market because interest rates and inflation and everything went down. That's the core to understand, and we'll also discuss Ray Dalio's recent letter. It all starts with inflation, explaining the long-term fundamentals, the medium-term impact, and the short-term noise. It's just noise, you will see, because the market is focusing on the Fed saying how they will raise until sufficiently restrictive. Real rates are still very, very loose, very, very stimulating. With inflation at 8%, if you have interest rates at 4, that's still minus 4% now. This is just an illustration from 2 months ago, but that is what it is. So still very, very stimulative. And then when you look at the Fed's plot, is still extremely exuberant. Okay, now we'll put rates a little bit higher, but then we'll go back to 2% forever, free money forever, likely negative interest rates. Everyone will enjoy it. GDP will be engineered to be 2% forever, no matter the fundamentals, no matter how much you work. The Fed will engineer everything. Unemployment rate will forever be around 4%. Recessions never again until the Fed is at the helm. And inflation will go from the transitory whatever 8-9% now to 2% already in 2024 and below 3% in 2023. These are all beautiful, beautiful projections, and that's all there is to those projections. Just beautiful to look at, to feel good, no recession, nothing, but the truth is completely different. And let's actually bet that the truth 2 years from now will be completely different from the Fed's projections. I've sent myself a scheduled email into September 2024 when we'll check exactly this video. This is my email if you want to connect me, investwithsven@gmail.com. In the video I said it will be wrong. Let's check it again 2 years from now, because usually the Fed is wrong, and actually they have to say things to keep the markets as is, because what they say also matters. And they always say something to keep inflation low, to keep inflation transitory, because what they say has an impact. If the Fed says recession is certain, then it's immediately stop investing, stop hiring, stop doing, and actually a recession comes. So the Fed is never allowed to say what they might think. That's also the core thing to discuss, the tools the Fed has to keep GDP high, to keep inflation at 2%. There is capacity, there is the impact, and then there is also the feedback circle of how what they do impacts the numbers. And Ray, it clearly states that it all starts with inflation and then goes deeper, because when the Fed loses control and their target is 2% inflation, good economic growth, stability of prices, and high employment, when they lose control, everything trickles down, and that trickling down starts from inflation. As Ray says, it starts with inflation because inflation is equal to the change in the amount of money and credit spent of goods and services divided by the change in quantities of goods and services sold. So much money printing, the services haven't changed much, and that leads to inflation. The key with Ray is that not what are the Fed's rates. The key is what are the real rates, and that's what matters. We have already seen that rates are still stimulative, and the Fed will have to push much higher to really make it significantly for cutting inflation. Then it goes to other markets. We already see the financial markets going down. Then it goes to the economy. And that is also something to understand when it comes to the Fed. Now the problem is too high inflation. Then it will be weak economic growth, and then the policies will be targeted and changed to bring those things into what the Fed requires controlling. So if we look at what are their targets, they clearly say inflation 2% objective, high employment rate, stability of prices, GDP growth. But the thing is that they can't predict that. Their projections are bullshit, as we'll see in a moment, also different projections. And if they are wrong, that changes everything. Let's discuss. These are the beautiful projections. We already saw them. These are, again, everything will be great already in 2025, a little bit here of issues, but if we look at what Ray is saying, 5% inflation ahead, if things remain stable, if there are shocks from droughts, floods, whatever, wars, inflation will be even higher. Right now, the market is discounting 1% for the next 10 years. What does that mean? Well, if the 10-year inflation expected is 3%, the 10-year treasury is 4%, real rates are 1%. That's what the market is thinking and being happy with 1% real rates. But with the fundamentals there, with the deficits of the government, with the Federal Reserve selling assets on the market, who is going to buy 8-9% of GDP? Where will that come from? Which means that interest rates will have to go up, reduce private sector credit demand to balance the supply. That leads to the cutting in private sector spending and hence the economy going down with it. That is what's going on now because the Fed will lose control and they are trying to lower their balance sheet. But if you call this a decline, this is just talk, not action. And on predictability, Ray Dalio knows anything can happen while the Fed is pretty convinced it will go down their way. So to me, it seems the Fed doesn't know anything or isn't allowed to say they cannot predict it. So that's their job, but be sure to invest in a way and do things that whatever happens, you are okay. Ray Dalio estimates a drop of 20% in the markets and everything from interest rates and then further 10% from an economic situation going downward. So that's already 30% more on top of the 20% already, which is a 50% crash, which is pretty terrible for everything. The economy will be weaker than expected if rates go up, and that is without consideration to the worsening trends in internal and external conflicts and their effects. So when it comes to investing, I think we have to find a way to invest that whatever the Fed does, we do okay. Let me explain. This is Alphabet. I tried to buy it here for the YouTube portfolio, then I bought it here, but it's a business, and let's say that in a terrible economic environment, it will grow at 7%. In a great economic environment, it will grow at 12%. 7% is a 2x in 10 years. 12% is a 2x in 6 years. Can you know what will be the range, whether it will be this or that? You cannot know. So in 2030, the stock can be at 150, the stock can be at 250. If it is at 150, your return on investment real will likely be zero, just inflation, still good. If it is at 250, you will have likely some positive returns. That's investing. If you buy a business, then you have to find businesses that will do good no matter what the environment is. Of course, you have to always keep in mind that this 99 next year can be 50 and be ready for that. This is investing short term, long term investing. What will be the case for Google? You never know. You try to find investments now that whatever the Fed farts, you will do okay. That's the key, and that's the main message I have here. This is called value investing. That's what works. So subscribe to this channel. We'll keep pounding and analyzing companies, Google coming on Sunday and everything, so that you can see how to find those investments and structure your financial life so that no matter what happens with the Fed, you do well. Thanks for watching. I'll see you in the next video.